Good afternoon, everybody, and a warm welcome to the credit webinar. I'm Cindy Bishop, representing Cindy Bishop Worldwide, and it's a pleasure to introduce our esteemed master instructor for today, Kelly Catalinas. Now, let's turn our attention to Kelly, a seasoned mortgage loan officer, for those of you that don't know her, with over 3 decades of experience. Kelly has not only excelled in her career, but has also become a leading lender and branch manager. Her expertise extends to training agents and lenders, enhancing production and cultivating lead generation. She's super good at business building. In recognition of her outstanding contributions, Kelly has been honored with the 5-star professional award for the 3rd consecutive year, prestigious accolade featured in the Washington Post magazine. This honor is bestowed upon only 8 individuals out of 4,526 who have received it 3 years in a row. This is one of many awards that Kelly has received regularly. What truly sets Kelly apart is the trust and admiration she's earned from her clients and agents and those of us who work with her on education. With over 95% of her business coming from referrals, today Kelly will share her expertise on credit to help you do your business more effectively. And without further ado, let's join in extending a warm welcome to Kelly.
Hi, everybody. Thank you so much for the very kind words. Whenever I'm feeling not so great, I could always count on Cindy to cheer me up with that nice thing. So I appreciate it. I'm happy to be here with you today. We're going to go through not a ton of slides, but it's a lot of information. And I do want this to be interactive, so you can put questions in the chat. You can unmute. Chances are, if you have a question about something, others will today too. Everybody is always concerned about their credit. So we're going to cover the basics and go through, some things that are myths about credit and some things that you can discuss with others about credit too. Chances are, if you're working with buyers, it's always a good idea, to ask, hey, do you have any concerns about your credit? Is there anything you need to address ahead of going out searching for homes? Have you spoken to a lender, et cetera? So we'll get into that. And I'm going to move on to pretty much start with, what is the definition of a credit score? I mean, it sounds kind of self-explanatory in that it's a numerical representation of the likelihood that you will repay any credit extended to you. Okay. But you have to remember that it is just a snapshot in time. Okay. It can change with new actions, and it can also change with the passage of time. And I'm going to get into those timetables a little bit later. Okay. But for now, when you look at the ranges of credit, and it doesn't matter what type of thing you might be applying for, you could be applying for auto insurance, right? And they might want to run your credit. You could be applying for any kind of loan, personal loan, mortgage, whatever, and they might use various methodologies to run your credit. This is the basic buckets of credit and establishing how lenders look at that from a standard factual basis, meaning we're pulling credit from 3 bureaus when we do a mortgage. Okay. So you have your excellent category, which is 800 to 850. But I can tell you from a rate and pricing perspective, if you're 780 or higher, you're really in the highest ranges. So anything above 780 is going to give you the best pricing in terms of interest rates. Very good, obviously, is 750 to 799. Good, 7 to 749. And there's a lot of product available in that 700 to 740. Okay, especially if you move into jumbo categories of loans, non-conforming loans, they're looking for 700 and up typically in the jumbo arena. There will be some at 680 and higher, not so many below 680 in the jumbo arena. Okay, so 700 is a very safe, very open, kind of like there's a lot more product to look at if you can get 700 or higher. In the fair category, I think this is kind of a misnomer because many programs look for a minimum of 680. So they bundle in this 680 to 699 and call it fair. but there's a lot of good product at 680. There's affordable housing products at as low as 620. So where the reason a lot of times this is categorized as fair is in certain conventional loan programs, you've got higher mortgage insurance costs based on credit scores. Okay. So the better the score or the cost for private mortgage insurance. But that fair category is 699. And I honestly don't think poor is 600 to 649. Usually below 620 is where you have some challenges, right? There are still good like FHA products and veteran products for VA loans that will do 600 and higher, okay? It just depends on the circumstances. Sometimes a lower credit score is the result of short credit, meaning you have a person who just never believed in credit, or maybe they're just getting out of college and they don't have a history of credit. So the credit scores come in low because there's just not enough to take a decent sampling with, okay? So there's a lot of reasons why scores could be what they are. In most cases, lenders are not looking to do mortgages with credit scores below 600. They're rare. We do offer an FHA product at a 580. It is a downgraded product. It is a manual underwrite. It requires a higher down payment than the minimum, but it is out there. We do offer it in the case we run into a situation like that. So typically below 580, there's not a lot available. So this kind of just gives you an idea of where would you find the best terms? Well, that'll be in your green buckets, in your orange and yellow buckets. You're going to be eligible for the most loans with good rates, right? Those are the areas where you're going to see affordable products. Most people are going to land in these categories of loans in general, and then only, secured loans might be given in that poor and, very poor range. Okay. So the credit score breakdown, I'm sorry, this is a little blurry. I tried to get it a little clearer. But let's go through it. Let's focus on the left side of the screen first, the pie. So you can, and then I'm going to go through it on the right. So payment history in green is the largest piece of that pie. It's 35% of the makeup of your credit score. They're looking back, right? How did you make your payments in the past? Are you current now? Are there delinquents now, et cetera? When we look at the payment history at 35%, they're focusing on on-time payments or late payments, how long that credit history has been positive, and what's the severity as well as the quantity of delinquencies. Usually if, you've got 3 accounts and one had a 30-day late payment on it 3 years ago, you're not going to see too big of a deal there. But if you have those same 3 accounts and you forgot to make your credit card payment last month, you might see a big change in your credit score because of how recent it was. Okay. So the more history behind you of any credit event, the better the score will move. Okay. The next bucket to the left is the amount owed, is 30% of the score. Okay. So too many credit cards with balances can lower a score. A lot of this in the amount owed is also a function of the percent of credit to the balance on the account. For example, if it's a credit card, a revolving account, you have a limit of 5,000 and you owe 5,000, that's going to hit your score negatively compared to if you have a limit of 5,000 and you owe 1,000. Okay. If you kept those balances to 30% or less of the high credit amount, that will help you in your score. So some people, especially people who have a lot of debt, will constantly be looking to close out credit cards and move them to promotional offers on new cards. They could be doing their credit score a very big disservice in doing this, because the length of the card opens, remember, is your payment history. Okay, that helps you in your score. If they open a new card and maybe move some of it to it, that might be less damaging than closing the card and moving all of it to it. Again, we're playing the averages here. We would rather see the 3 cards with 1,000 apiece on them than the one brand new card with a limit of 3,000 and 3,000 owed. So you kind of got to play it a little bit. You know, there have been cases where I've had borrowers. I had one borrower that literally had 42 pages of credit. It was the biggest credit report I had ever seen. And, you know, not all of it was current, a lot of it was old, but they were managing it. They had good credit scores, you know. So maybe they played the game of moving things around. You know, in doing that, and maybe that's, they're paying attention to what they're doing. I'm not saying don't do that, right? I'm just saying pay attention to it. It may be worthwhile not to close those old cards out, but maybe just move balances and keep them open, etc. The next bucket is the credit length, right? The length of the credit history has a 15% weighting on that score. So the longer the credit history, the better, right? It's just statistically speaking, there's more for us to look at in that case. And sometimes with the longer history, you might have had an isolated event. You know, there could have been something that happened 3 years ago. Credit was reestablished since those 3 years. We could explain that away. Scores are reflecting that, hey, it was a blip in time. It's not representative of my overall history, and it gives us more to work with when we're submitting our files. How long have the credit accounts been established, and you know, how long since you've used certain of them? So some people, you know, have cards that might be sitting in their wallet that they haven't used in 12 months. Well, they might not know it. The creditor could have probably canceled the card, you know, or maybe they got notification or they didn't, and they go to use it and it's not available. Or maybe they diminished the limit because you weren't using it. You know, you don't need a ton of cards, right? Ideally, we would like to see 4 pieces of credit if we could, one with at least 24 months of history on it. For most programs there, if we have 4 pieces, one that was at least 2 years old, many of the programs will look at that and say that's fine. I'm saying that because in the jumbo arena or non-conforming arena, because of where we live, a lot of times they require a 24-month history on at least one account. So if you had 4 pieces of credit, maybe one's an installment loan, maybe the other 3 are credit cards. You might have one you never use. I always say to people, use it 1 or 2 times a year. Go put gas on it and pay it off, you know, or go to the grocery store and pay it off. Just keep it active so that it doesn't get canceled, and keep it in the count for a better reflective credit score. Okay. Did anybody have a question on that before I keep going? Okay. New credit has 10% of the weighting. And a couple of things about new credit that you need to be aware of. When we do a mortgage loan, we pull your credit at the beginning of the transaction, right? We submit everything off of the way that credit report looks. That credit report is valid for 120 days. We address anything that needs to be addressed on it, and we move ahead. When that loan gets closer to the settlement date and you are within 7 business days of signing, we are required to do a soft pull on that credit again. We have to be sure that the borrower didn't run out and buy all new furniture, buy a new TV, establish new credit or debts during the loan process, okay? So we counsel them ahead of time, don't do that, right? We don't want more debt. We don't want anything to change. We don't want inquiries showing up at the end, because if all of that did occur, and let's say it was a loan that was based on a 780 credit score as far as interest rates and private mortgage insurance, et cetera, and it's now dropped to 740, well, the cost of their loan just went up. not only did their mortgage insurance go up, but their rate could have possibly gone up because their credit score might have dropped between the start of the application to the finish of the application. So we want them to be consistent. We don't want a lot of things happening during the process. And if there is something and they have a question for us about it, let them ask us. That's always best. So, and then credit types, okay? Example of ideal credit mix, that's 10% of the weight. So let's say you've got 2 installment loans and 3 revolving accounts with balances. Well, 2 of those we know are going to end, right? They're installment. They have a finite number of months remaining in them. And typically with installment debts, if we're talking conventional lending, we typically don't count those monthly payments against our borrowers if they have 10 or less remaining on that installment, okay? Student loans, right? Student loans are starting up again, but let's say we run into a student loan that is in deferment. We still have to count a monthly payment for the student loan. So depending upon the loan type, there's a calculation we can go to and come up with that monthly payment for qualifying. If they have evidence of what the payments would be at the time that they are to start up again, we will take that and try to use that payment instead of just the guidelines we have to follow. So, you know, the healthy mix is having several different things, right? You've got balances on your revolving debt, as we mentioned before, about 30% of whatever the limit might be. No collections, no public records, no foreclosures, and ideally no late payments. But of all of those, the best would be to not have bankruptcies or public records or collections or anything like that on the credit. Any questions on that before I move on?
Kelly, I have a question. For example, if I have like a really big balance, not balance, actually, I'm using my credit card to the fullest every month, but I'm paying it every month as well. How
That's
does
fine.
this affect?
Yeah, totally fine. It should not impact you negatively at all because the score will reflect that management of it. Because you're not carrying it over and over. You're just using it and paying it, using it and paying it. So I would imagine you would have very good credit.
I see. So like if I'm using it to the max, that's fine.
Yeah,
As long
because you're
as I
zeroing it
imitate.
out. Right.
Mhm.
You're not
Okay.
carrying it over. You're zeroing it. So yeah, while it might show up that there's a balance at any moment in time, the history doesn't support that it's carried.
Okay.
It just shows usage, correct?
Okay, thank you.
Yeah, sure. Okay, so 5 credit myths, and I covered some of these, but we'll go over it again. So paying off and closing out a credit card will increase your score. Well, we just talked about that, right? You don't want to close those accounts that you might have had since you were in college just because you got a new card. You know, you would want to keep that old card for its history, use it a few times a year, pay it off, but you've got all of this statistical record of showing you were able to manage that card adequately. So paying it and closing it won't necessarily increase your score. Now, in some cases, people who have trouble with their credit and have too many cards, you know, they might say, Kelly, I've got 20. Well, and they want to get rid of some, then go ahead. You know what I mean? Because you've got enough, statistically speaking, to look at the other things. But just paying it off with the hopes that your score is going to go up 100 points is not necessarily going to happen at all, right? Paying a collection will raise the score immediately. Now, this is a tricky one. A lot of people think like, oh, I'm going to really impact my score right now. I'm going to go down. I'm going to pay off that $70 cable box I forgot to drop off collection, and my scores are going to pop right up. The opposite is actually true. A lot of times, if there's a collection that's been outstanding on a credit report for quite some time, if you go and you pay it off today, it's kind of like an admission of guilt, right? You agree you owed it, you're going to pay it. You might actually see your credit scores drop initially, but then over time come back up. So what I always tell my borrowers, if I'm showing collections on a credit report, don't touch them. Let's see what the underwriter says. If or sometimes if they're below $500, you don't have to pay them at all. Sometimes when they're below 1,000, you might not have to pay them. So it just really depends what it is. They have improved the credit reporting to not really count the medical if it's medical collections in terms of impacting the scores. That was a boost recently to try to take the medical collection pieces kind of out of the calculations. So I would say check the credit first. If there's a collection that shows, we would discuss that with the borrower. But I would always leave it up to the underwriter to make the decision as to what has to be paid or not in terms of doing that loan. Paying off an auto loan or student loan will improve your score. Not necessarily, again, if you're paying it on time, it's got a good credit history, you're managing it, you qualify with the payment, leave it, it's fine. Some people race to pay off their debts because they want to buy a house when they can adequately qualify with the monthly payment, and maybe they need that cash to put a higher down payment down or to pay points to buy the rate down. There might be a better use of that cash in the transaction than rushing out to diminish their debt, okay, knowing that those installments will ultimately go away at some point. That's a conversation we have all the time. We might say, look, you could do 3% down, but if you don't address your debt and we go with 5% down, maybe your private mortgage insurance drops about $40 a month. Is that valuable to you? Or maybe you hang on to that cash because right now, the way pricing is and interest rates, you get a lot more bang for your buck if you pay 1 point today than you did a year or so ago when rates were lower. So most of our loans right now will have a point or more in them because there's just more value in spending the money that way than any other way. So, let's talk about how to use your money before you rush out to pay off a debt. I mean, paying off a debt to qualify for something, that's fine. Like that we could suggest, right? If we get rid of the car payment, you could buy this much more house. That's a different conversation. But just to say I want to get rid of it when in the scheme of how they, have interest deductions on their mortgage versus paying off that car, they might be a better way to do that, right? Opening a new account will hurt your score. Not necessarily. I mean, I recommend not opening any new accounts if you're in the mortgage process, but sometimes it's unavoidable, right? People are moving to the area. They've got to, get a car when they get there. They've been transferred or they're coming back from overseas. It's inevitable. They have to open something. So if you have a credit report that doesn't have a lot of activity with inquiries on it, and then they run out and they have to buy a car because of circumstances, it's normally not going to bother their credit score. As long as we qualify with any debt that occurs, it should be okay. But not okay if you're saying, okay, I'm going to change my mobile phone plan. I'm going to do that. I've got to apply for a credit report because I'm renting an apartment. And then, by the way, I need a new car. Well, now you've got 3 different types of debts. That will probably hurt your credit score because it's not like you're shopping for the same one mortgage, right? If you apply with me for a mortgage and 2 other lenders within the same 30-day timetable, we should all have the same credit score, because you're applying for the same type of credit within that same 30-day window. It's not different pieces of credit, okay? And then having too much credit available hurts your score. Again, not necessarily. If you manage your debt, right, you pay on time and the credit report reflects that you have been paying on time, it's not going to worry about how much is there. It's going to worry about how you're managing it, okay? So if you pay it on time, there's nobody telling you you have too much other than what it might impact you as far as your qualifications for what you're trying to do. Maintaining favorable credit scores. pretty common sense here, but we'll go through it. You do get to monitor your credit each year for free. You can go to www.annualcreditreport.com and order a free credit report every year. Okay, so that is your right. You can do that. 2, it says pay all of your bills on time or early. Obviously, you pay on time or early, that helps your score. Okay. I had a customer a few months ago who was traveling and had a 30-day late payment. And I think it was the second time I was doing the pre-approval. It took them a while to find a house where they wanted it. And the credit score dropped from like a 782 down to a 745. Just because they were traveling and missed paying a credit card, and it was truly 30 days late. So you got to be mindful of those dates when you're doing things. Don't co-sign loans unless you have to. We see a lot of parents co-signing with kids, you know, or people might say, hey, it's not your loan, I just need you to co-sign it. Well, you are liable. If you end up trying to go purchase something somewhere, that debt's going to show up on your credit report, whether you're a co-signer or not. So be mindful of that. Over the course of the last year, with interest rates going up, we've had a lot more strategizing with parents, co-signing with kids to try to get them into their first home. That's a strategy discussion, right? You're trying to get them in a home so they can buy the home now before prices continue to rise. And then hopefully at a later point, they're going to refinance out of it into their own name at lower interest rates, and parents go off of the note altogether. That's a strategy discussion, okay? So you're co-signing with deliberate there, strategy that it's short-term. The plan is to refi you off of that and release you from any liability. But we have seen that in the last year and a half. Again, don't close all revolving accounts no longer in use. It helps your scoring when the accounts are open with 0 balances. Like I said, don't close them, use them, put a little bit on it, pay it right off, just a couple of times a year, and that would be worth it. Again, don't open new accounts unless it's absolutely necessary. That is a conversation we have with our borrowers at the beginning. Sometimes it is absolutely necessary. But we just want to express to them that we can't control what the score might look like from the beginning to the end if new accounts are open during the loan process. So it could impact their qualification, it could impact the pricing on the loan, and it certainly could impact the private mortgage insurance component if they're. And then report fraud immediately. If you do find yourself to be a victim of fraud, you want to contact all 3 bureaus. The 3 bureaus are Equifax, Experian, and TransUnion. They are all online with a .com after those names: Experian.com, Equifax.com, and TransUnion.com. You can go online, you can put freezes on your credit to protect them. That way nothing can be opened without your knowledge. It's very easy to do. You can do it online. You can also manage the freezes that way as well. So you can say, you know, I had a borrower last week who was wanted to be pre-approved. I went in to try to run the credit and everything came up frozen. She says, oh my goodness, I forgot that I had frozen my credit because I was a victim of identity theft years ago. I'll go in and unfreeze them. I said, okay, unfreeze them for 48 hours. Sometimes it takes 24 for it to flow down to us when we go in and try to pull it, and then just put the freeze back on it. And then just know that as we get closer to settlement, I'm going to need you to unfreeze them one more time so we could do the soft pull, and then you could freeze it again. So it's very dynamic online to do it, not hard. I would just tell you, having done this myself, because I was a victim of identity, someone tried to use my social security number to claim unemployment benefits. So the IRS sent me a nice note on that and said, hey, someone tried to use your social for unemployment benefits. You didn't do anything wrong, but we're just letting you know, we put freezes, you know, you have credit monitoring and go in and put freezes, which I did, of course. But So I think you can really take good control online of your credit. If you're concerned about it, your consumers, your borrowers can do that as well. It has become much easier to do and manage it yourself. Now, the next slide is a hard one to read, but just bear with me as we go through it, and hopefully you can see it as much as you can. So credit events are always of concern, and when people have had them, it doesn't mean they can never buy a house. There's plenty of programs out there. If people have had foreclosures or short sales or bankruptcies, right? And what this chart details is what does the government products look like with respect to these credit events, as well as the conventional Fannie Mae and Freddie Mac products, which a lot of non-conforming and jumbo will default to as well. And then USDA, which is the rural housing loan for those areas where rural housing is available. In the first line, when you look at foreclosure under FHA, it's 3 years from the date of the completion in case number assignment. VA, by far, of all the products you're going to look at, is 2 years from the discharge date. Okay, so very liberal in VA. They are always working to help the veteran. I am a military certified loan officer. It's very near and dear to me. So 2 years from date of discharge or the date it was transferred out of the borrower name. Now, conventional Freddie is 7 years from the completion date on foreclosure. So believe it or not, foreclosure is worse than bankruptcy in terms of the waiting period. Okay, a lot of people don't think that, but foreclosure is worse than if they had just gone ahead and done bankruptcy. Conventional on Fannie is 7 years from the completion date. If the mortgage was included in a bankruptcy, then the bankruptcy waiting periods may apply. So it's 7 years, except in the case of if they included the mortgage in the bankruptcy, you may get less, okay? And then again, USDA, typically not eligible if during the prior 3 years, the applicant's property went into foreclosure, but there could be exceptions in the rural housing space, okay? So short sale, FHA, same, 3 years, VA, same, 2 years. Freddie Mac actually gives a little leniency in short sale. If we are able to get an automated accept or approval through the automated underwriting decision, and, the credit reputation has been repaired since the short sale, we may be good there on Freddie. Fannie is 4 years. So you can see the short sale is 4, the foreclosure is 7, right? For Fannie Mae. So they would definitely want to go short instead of foreclosing. And then again, 3 years on USDA. Chapter 7 is typically a full bankruptcy. Chapter 7 normally includes everything and typically would include the mortgage in a Chapter 7. But they'll look at it in FHA. If they went with a full Chapter 7 bankruptcy, instead of filing for foreclosure or short sale, it's 2 years from date of discharge. So it's 1 year shorter, okay? VA, same thing, 2 years from discharge. Conventional Freddie, no reasoning period if you can get an automated accept through the decision engine, okay? If you can't, then it's probably going to default to what Fannie does, which is 4 years, okay? But we would put that in. We'd have more flexibility under Freddie than Fannie in the Chapter 7. And then, again, USDA, no seasoning period, but if we get an online accept, we might be fine in Chapter 7, or we might need 3 years. It just depends. So Chapter 13 is interesting because Chapter 13 in many cases includes everything but the house in a lot of cases. So on FHA, it's 1 year of the payout period elapsed, and we have to have the bankruptcy court grant permission in order to provide a mortgage to that individual. VA 1 year, satisfactory payments made, same kind of thing, and permission. Freddie says if we get an accept, automated accept, even with that in the credit history, we don't need the seasoning at all. And then Fannie is 2 years from the discharge date or 4 years from the dismissal date. Okay, so depending upon how the court handled that. So consumer counseling plans, you don't hear as much about these as you did many, many years ago. Some people get into consumer counseling and it actually hurts them in the home buying process. FHA says if the new FHA case number assignment is within 1 year of satisfactory payments of the 1 year elapsed payout period, and you have to have the permission from the counseling agent. Okay. So I think there are tools where maybe the borrowers don't have to enroll in credit counseling, but they could work with an organization that could put them on the right path and tell them what they should take care of first in order to get their credit scores up, and how to focus their energy. That way, you know, we don't want them giving money to an agency and telling that agency to pay their credit for them. We want them managing their own money and then focusing on those things that are going to achieve the credit score as soon as possible. And then credit counseling is not acceptable on Fannie or Freddie. And then 1 year, again, USDA, much like FHA for the payment history from the elapsed payout. So I know that's a lot of information there, but it kind of gives you a sense of the timing of those credit events in the past and how we evaluate those. So again, I always just say, whether you're a borrower, a realtor, anyone really, because everybody is, you know, always concerned about their credit. I would tell you, if you're considering home ownership and you have any concerns about your credit, please talk to a lender 4 to 6 months prior to beginning your search. Some people get the bug and they want to start looking at houses, and then they find out they have things on their credit that they never knew about. I would say back that up a little bit, you know, just in case, if there are things that put you kind of on the cusp between fair credit to good credit or good credit to excellent credit, and it impacts your rate and it impacts your mortgage insurance premiums or whatever, then let's try to work to get that score up so you get the best terms available to you. And we might need 90 days in order to do that. One thing I didn't mention on the prior pages is that your credit does roll over every 90 days. Typically, if you, let's say you paid off a debt, okay, and you're trying to see the impact to your credit score, it might not happen in the next 30 days. But it should definitely happen within 90 days of that event, okay? So usually the cycle is a 90-day cycle. You know, your borrowers, you might want to complete a preliminary loan application. Let's take a look at the credit, see what programs are available now. And then if those programs don't work now, then maybe we can assist with strategies to improve that credit so you have better opportunities down the line. I had a customer last year who was a veteran and, you know, did an application and said, you know, I don't think I could do anything right now. I really want to get my credit scores up and do A, B, or C. And the one nice thing about FHA and VA financing is they are very forgiving on credit. I said, you don't need to do anything with your credit. I said, I want to say the credit score was about 665. I said, your interest rate for you as the veteran is the same as if you had the credit score at 780. That's how good the VA loan program is. So you could buy right now, you know, and they did. While rates were low, they went out and they bought. I'm like, you do not have to do anything. So a lot of people hear things that may be only applicable to conventional lending, Fannie Mae or Freddie Mac lending, when if they would just consider an FHA program or a VA program, if they have benefit, you know, you might do much better on the interest rates than you could in the other category. So, you know, always kind of talk to the lender. We'll look at everything, give them the scenarios one way and the other. And I do see more government contracts out there. I do see more listing agents entertaining government contracts. The reason being, the government still wants loans. The rates are better on FHA and VA loans right now than conventional rates. There's a big difference. Sometimes it's 3/8 to 0.5% better on an FHA versus a VA loan. So we need to get our listing agents on board because it lets us sell more homes if we can do that. Any questions? I hope everybody got something out of that, but certainly we can open it up if anybody's got any questions. Quiet group?
It was just too excellent of an instruction.
I don't know about that, but thank you.
Now, listen, the video replay, it takes about 3 hours for YouTube to render it at this time of day. So
Okay.
later today, anybody can go to Cindy Bishop Worldwide to upcoming events. It's the easiest thing to remember. Down on the right, there's a button that says Meet Our Instructors. Just go there. Also, hi, Sean. Also, the Kelly, if you put a date on this,
Uh-huh.
then you're welcome to send this to them,
Okay,
but not without a date.
sure.
Okay, and I'm
Sounds
not
good.
emailing the recording. The recording
Sure.
will be on that page. Sean asked, but no, we're not
Mhm.
emailing links out.
Yeah.
One thing we have to do is control our stuff because, believe it or not, we've had problems with theft. So,
Mhm.
and I've got to protect your all's material. So that's exactly what we are doing. So it'll be on the instructor page. But as far as the PowerPoint goes, you're welcome to send it out. Just make sure you put a date on it first, and I'm going to send you the roster.
Sounds
So
great.
you'll know who came, which was most everybody. So
Sounds
thanks,
great.
Thanks everybody for showing up. Also, just so you guys know, we've got our 6-hour contract class tomorrow. We only do that twice a year. So if you're interested in that, it's cindybishopworldwide.com to upcoming events, and it should be the first thing in the feed. It's contracts and addendums. It's a full 6 hours. A very, very, very useful class.
Mhm.
Okie dokie. Well, thank you.
Sounds
Kelly.
good. Thank you, everybody.
Thank
Appreciate
you.
it.
Take care, everybody. Have a great day.
Take
You too.
care.
Bye-bye.
Bye.
Bye.